know what we're talking about here, Bat? And by the way, Market Measures is our big piece of research every day. This one's every day we sponsored by CBOE, Chicago Board Options Exchange. This week is their 50th anniversary, I think. I don't know if it's this week, but this year is their 50th anniversary, and they're having their big celebratory party.
That's right. You're a keynote speaker, right?
I am not a keynote speaker. I am
You're just a freeloading
attendee. Yes.
Ex-member.
Yes. Tony and I were both members of the CBOE for about 2 decades, and we have close ties, I guess. But and the Chicago Board Option Exchange, of course, is still in Chicago, and it's a publicly traded company.
CBOE is the stock symbol, right?
Yeah. And anyway, we were doing a bunch of stuff with them this year. In fact, we have a 4-part webinar series. The next one is on May 30th. And then we are doing 4 live shows with them. The first one is on June 10th in Dallas. So, but this one today, selling one or selling both. What that means, Bat, is, well, here we go. When we sell premium, we could take a directionally neutral stance and sell puts and calls, or we could take a directional stance and sell a put or a call.
Sure.
So what's the difference between selling a put, a call, or the strangle if the premiums are about the same for both? Remember, if you sell a 16 delta put and a 16 delta call, both out of the money, your position is going to show 0 delta risk, meaning 0 directional risk at that moment.
Time.
Yeah. Right. And so it's a very different play than selling a naked put, which makes you bullish, or a naked call, which makes you bearish. All right, that's all. So we're going to take a look. What do you think, Bat? Is it better to odds selling a put, selling a call, or selling both?
I can only tell you, if I don't know what the study's going to find, but I can only tell you from my own personal experience, and I've said this numerous times on the show. I mean, anytime I've been directional, if I sold both sides, I think I'd be in a better place. So for me, it's going to be both. I
can guarantee you, after doing this for a little over...
After watching you trade for the last 12 years...
After doing this for a little over 40 years and watching the Bat... and painfully watching the Bat trade for the last...
You had to add an adjective, huh?
I had to add painfully.
Watching wasn't a big enough adjective. Gotcha,
for the last 12 years or so. What I can tell you without... just from studying our own trading, I wish I had always sold both instead of just selling one or the other. There was a long time where I mean, after trading through the 87 crash, I wouldn't sell puts for about 10 years. I was a little shaken up by the 87 crash put wise, and then selling calls has never been a problem. But when I sell calls, I never like to sell puts. Now. I sell both. I guess there's a few situations where I will sell some naked puts. I occasionally sell some naked calls, but most of the time I sell naked puts. But I've always done better when I sell both. I don't know what the study's going to say either, but let's take a look. So since 2005, the 20 delta strangle, the 33 delta put, and the 35 delta call collected around 325 per trade. So you're going to say, well, why would you guys do a 20 delta strangle, a 33 delta put, and a 35 delta call? That's because we wanted to get to the same 325. All right, we're trying to get to the same price. So we adjusted
net the same.
Yeah. So we adjusted the options to make the study more valuable, so we can compare apples to apples. So in the SPY, if we took a 20 delta strangle, I sell 20 delta calls, 20 delta puts, we'd collect about 325 over, this is since 2005. And which means, it's a lot higher now, but because at different times the market was lower, that's why the number looks a little weird. So we are going to, and then we looked at the 33 delta put, collect 325, and the 35 delta call, collect 325, right? So, and then you can see the deltas down below, all right? So we matched everything up. Clean as could be.
Sure.
Next slide. So 2006 to present, compared the following. We sold 133 delta put, 135 delta call, and 120 delta strangle. We sold them at 45 days to expiration, and we managed at 21 days. we computed the following statistics. Now, if you're wondering how we do all this, we have built, over the last 11 years, we have built a really, and a big thanks to Dr. Data and the rest of our database team, but we've built our own in-house database with tons. It's taken us literally 12, 13 years to do this. So we can study things that are like insane like this. And we can do them overnight, so we can have stuff for you, like this every single day. We computed the following statistics: the win rate, the average P&L, the total credit received since 2005, and the standard deviation of P&L. That means kind of like how big were the swings on a trade-by-trade basis. And we do all this because we want statistical validation for what we talk about on air. It's important to us. So we're not just babbling about what Tony Batista or Tom Sosnoff think. We're telling you kind of what the research shows.
Numbers behind it.
Yeah. Let's go to the next slide. So, despite the majority of the study being in a bull market, remember, since 2005 to 2023, or since 2006 to 2023, we've pretty much been in a bull market, except for, a couple of 5 different periods throughout that time where we had some sell-offs. But despite the majority of the time being in a bull market, the strangle had the lowest standard deviation of P&L and a win rate that was similar to the short put. So first thing we go, strangle 71%, the short put 77%, and the short call 56%. Now the short call's lower because, like you said, we're short a call. This is a bull market. But the short put, 77%. Now remember,
you don't know what's going to happen in the future, right? Like you don't know if it's going to continue.
Of course.
The short call would have a better win rate if we were in a bearish market or the market had done worse over the last 10 years.
And again, you don't know what's going to happen. So you look at the average P&L here, and you're like, after you look at the win rate and the average P&L, you're like, okay, well, if I knew we were going to be in a bull market, I'd obviously sell puts and sell puts only. But since we don't really know that, I'd rather do the 20 delta strangle, right? Okay, so far so good. The total credit received, we locked these up, so they're basically the same thing since 2006. All right. So in other words, because we made all the trades at the same dollar amount, that's the total credit. So we did the study with enough data so it's statistically significant. There's $84,000 of credits, so we had plenty of stuff to work with every 45-day cycle. And then the standard deviation on a trade-by-trade basis, well, you can see the strangle has the lowest swings. The short puts had the highest, and the short call, similar to the strangle. But when you just look at this slide here, this is a pretty... But
you have a negative P&L in the short call. That's the problem.
Right. But when you just look at these slides, this is a pretty good argument for, the short strangle, because you don't know what the market's going to do. If you know what the market's going to do, you want to be short the puts. And correspondingly, if the market went straight down, you'd want to be short the calls. But you don't know that. Let's go to the next slide. So with 2/3 of all the trades since 2006 resulting in the market making an up move, the strangle would seem like it would drastically underperform the short put. But the results were not that much different. So if we look since 2005, remember the percentage of positive 24-day results. That means like between 45 days and 21 days. 65% of those 24-day periods were bullish, and with a pretty high average annual return. Let's go to the next slide. So additionally, the short put saw 33% larger outlier loss to the strangle, but both the overall standard deviation and the outlier risk were lower on the strangle. So what's interesting here is that that you might have been scared out in like 2008 with the put because the put losses are a little larger. But what the research team is saying here is that when you look at the returns over 16 years, you had the lowest standard deviation of risk in the 20 delta strangle, and you had a middle, an average win rate and a decent return on capital, or a decent profit, with the smallest amount of risk volatility. So that's the argument in this case in a bull market. Let's go to the next slide. So For the same amount of premium sold over time, selling a put and a call showed a very high win rate, positive P&L, and the lowest standard deviation of P&L compared to a naked put and a naked call. This is the same kind of results that Tony and I have experienced on our own from just trading for 4 decades. You know, whenever we think we know something, we find out we would have done better if we just done both sides.
Sure.
Despite the short put outperforming in a bull market, the outlier losses were 33% higher than the strangle. So strangles are more manageable in a bull and bear market than puts or calls alone. The other thing is, it gives you, it's a lot easier to sleep at night knowing you're actually flatter. I know you have risk in both directions, but you're actually, you know, flatter if you just.
You do sleep a little sounder, don't you?
I do.
Yeah, I agree. All right, good job. Good job out of the team. Good job out of you, Tom. You know what? You did an excellent job with that market measure. I mean, I was impressed.
You were moved to tears.
I was moved to tears. We're going to take a quick 90-second break. Somebody else who moves me, Mr. Scott Sheridan, coming out. Tasty Trade World Headquarters. We'll be back in 90 seconds.